How's it going, everybody? My name is Antonio, and I'm on the barbecue today with George Ogilvie, the CEO of Arizona Sonoran Copper, which, well, as you might have guessed, is a copper exploration and development company with assets in the United States, specifically the Arizona Sonoran Desert, hence the name. Who's not here with us today, though, is your financial advisor. This conversation is not going to include any recommendations to buy nor sell anything. This is going to be just a talk, a casual talk that's general and impersonal in nature, as well as a conversation that should, under no circumstances, be used as independent research, because it's going to include a lot of forward-looking statements about uncertain events that may or may not happen in the future. I would suggest taking the minute to pause the video right now and read the full warning that is on your screen right now, because the mineral exploration, development, and mining industry is among the highest risk industries out there, and you will lose your money if you don't know what you're doing. And if you don't further your own research by visiting the company's official website, reading the official filings on Salyer.com, and consulting an official financial advisor before making any decisions, which none of us, as I said, are. That all said, Arizona Sonoran is a $170 million market cap company, which is divided over about 110 million shares outstanding, and that makes it about $1.55 stock. There are almost 2.5 million warrants and 5.5 million options, which means that there is about 118 million fully diluted shares. Rio Tinto owns about 7% of those shares. Tembo Capital owns about a third, so over 30%. Another third is owned by institutional investors and ETFs, among which, for example, the Sprott Copper Juniors ETF, COPJ. There is 5% owned by insiders, and the rest is well, a mix of retail and whatnot. The stock trades on the Toronto Main Board Exchange under the ticker symbol ASCU, where an average of about 30,000 shares trade a day, with a 52-week low of about $1.50 and a 52-week high of a little under $2.50. On August 14, the company had about $18 million in cash and also no debt whatsoever, nor short nor long-term debt. Company's flagship asset is called the Cactus Project, which lies between the cities of Phoenix and Tucson in Arizona. It's actually close to a smaller town. It's called the Casa Grande. It's about half the size of Phoenix, if I'm not mistaken. There used to be a mine there in this spot. It was called the Cactus Mine. It was an open pit mining operation, copper mine, of course, part of the larger Casa Grande mining district, actually, which it's a famous district because mining can be dated as far back as I believe the 19th century, so the late 1800s type of thing. This mine specifically didn't produce much beyond the mid 80s, mainly because of economics, but something we can talk about later on. The fact that there was a mining operation here before, though, i.e. this is a brownfield project, does mean that there are no infrastructure concerns, and that the fact that this project is on private land also means that the permitting process should be easier. Not necessarily easy, but at least easier. Not a huge project, so it's about 5,000 acres, which for people with common sense, it's about 20 square kilometers, and it's in the heart of this land package is where we find the Parks and Salyer deposit and the Cactus deposit. There's an MRE stage on the Cactus as of recently, and it's currently being advanced. So the whole thing is currently being advanced towards a PFS and then eventually a DFS, with first copper cathode production expected in 2026, and with hopes really for mining this deposit beyond 2050. So a long mine life here. In total, there is about 5.2 billion pounds of copper in the measured and indicated category, as we saw a couple of days ago. That's at a grade of about 0.6%, and another 2.2 billion pounds in the inferred category, and that's at a little bit of a lower grade, about 0.5%, to round it up to actually 0.47, but you can say 0.5, I assume. Most of it is leachable, according to the recent MRE, so about 85% can be leached at about 0.62% copper, and that's in the measured and indicated category. And about 60% of what's in the inferred category can be leached at about 0.6% copper. So that's for a total of about 4.5 billion pounds of leachable copper here. Now, geologically, this is, well, since this is in the Sonoran Desert, most will probably know, but mineralization here is driven by a large copper porphyry system. So it's a copper porphyry, it's what it is. So it is mostly hosted, to put it technically, it's hosted in very old rocks. That's what it is. So we're talking Precambrian granite, as well as some younger rocks too. So they were they basically intruded a pre-camp. Long story. So it's like laramide, monzonite, for example. I say younger, but those are about as old as the Rocky Mountains themselves, so not that young. And again, there's also with those, you have the quartz, monzonite rocks. So those monzonites basically broke into the sort of the cozy Precambrian granites home because it was too hot down there for them to stand still, and then that created the monolithic breccias, which are important for these type of deposits. I don't know why I'm telling you this, because it probably doesn't mean much to people with active social lives, though. So I'll try to shut up now and just welcome the CEO. So George, thank you for investing your time with me, sir.
Hey, thank you, Antonio. Appreciate the opportunity.
Pleasure is all mine, of course. First time we're speaking, though, so I have an obligatory good, the sort of the good, the bad, and the ugly first question. So let's start. Why don't you give me three things that you very much like about your own company, but then also talk to me about three things that you would change if you could do so by the push of a button, or by swiping a magic stick.
Well, you've touched on some of the key attributes for the project. I mean, obviously it's copper. And I think if we, take a medium and longer term viewpoint on copper, I think, as we all know, with the drive for decarbonization and trying to remove the world from, fossil fuels, there's certainly going to be more of a drive for green energy. And certainly, the transmission of electricity from one point to another really requires copper. So I think as far as the supply and demand fundamentals are concerned and our timing on this, I think they're going to be quite exceptional. And that should, bode well for the shareholders of the company over the medium and longer term, that they're going to see significant uplift in valuation from where the company is currently valued today. What I also like about the project is, obviously it's located in the heartland of the Arizona Copper Belt, which has, as you rightly pointed out, over 100 years of mining within the district. So we're in certainly a very safe tier one jurisdiction from a geopolitical, socioeconomic perspective. So that's what I really like about the project. And then I think, lastly, what I like about it is, obviously we're in the southwest of the US. Water is a big issue. Obviously, that part of the world has been, suffering from a drought, and we have an abundance of water actually in the ground in a natural aquifer. So the project has water rights to the year 2070, so for the next 47 years. And there's a natural aquifer in the ground that currently has existing wells. We have piezometers in those wells. We measure, the volume and the flow of water. We even pump water from those wells into a surface reservoir holding pond, and we see more than enough water for all of our business needs. And that water is only permitted for industrial use, which obviously is also very appealing. So I'd say those are probably the main three attributes which, really attract me to the project. As far as, what maybe on the opposite side of the coin, three areas where perhaps there are weaknesses or things we'd like to improve. We put a PEA out 2.5 years ago in August of 2021. At that time, the production profile was 28,000 tons of cathode production per year, and the mine life was sitting at 18 years. Usually in the copper space, to have any real relevance, you want to try and see if you can have 50,000 tons of cathode production per year. So, that's certainly one area where we see a weakness, and we're trying to improve that with this pre-feasibility study that you alluded to earlier. That'll come out early in the first quarter of next year. And we strongly believe that that's going to show, on average, a production profile around about 50,000 tons of cathode production a year, and the mine life is going to be pushed out beyond 25 years, which again is another significant uplift on the project. We always get asked questions as well about permitting. The permitting here is a little bit easier given we're all on private land. There's no federal nexus. We're only dealing with the state regulator and the local municipality. And to date, we've had great success in permitting the Cactus assets. That would be the open pit, Cactus West, Cactus East underground, and the surface stockpile. They are actually permitted today as per the PEA. But I suppose if there's one area of doubt that people may cast on the project as Park Salyer is not currently permitted. We only put out a maiden resource on that last September. And of course, we put out an updated resource, as you alluded to, just in the last couple of days. So with the pre-feasibility study being completed, we have to go back to the original permits and have them amended to actually then include Park Salyer plus the larger production profile that I just shared with you. So that's one area. I think if I could wave a magic wand tomorrow, I'd like that to be done and dusted, so the market, has extreme confidence that the full project is fully permitted. And then, of course, there's always the social license issue. We do have a very strong social license here, but at the end of the day, we can't prevent, NGO groups or people who, want to oppose the project turning up on public roads and perhaps trying to, thwart the project moving forward. But the good news is to date, we haven't seen any of that activity in this area, which is very, very pro-mining.
Well, there's a couple of things to talk about there, and the recent MRE should, of course, be the focus here today of the discussion. And something that stood out to me immediately before even looking into the MRE itself is that you liked what was reported in there, especially with the growth in the MI resource of was it over 220%, I believe. There's growth in grades too. There's growth in leachable mineralization, which is important in this case. So not too bad at all. But the market didn't quite think that way too. I mean, stock is down what, 4 or 5%. I mean, the market didn't discount you massively, but it wasn't as enthusiastic about it as you are. What's happening there?
Well, I think it's more to do with what's happening on a macro level. I mean, copper at the end of the day is really a bellwether for the economy. And as we know, Western and world economies are, seeing sluggish GDP, there's rising interest rates. So it's really putting a dampener on economies. And then a lot of people in the copper space pay very close attention to what's going on in China. And of course, in the past several decades, big consumers of copper in China have been the property developers. We know the struggles there. And of course, two of the largest property developers in the US right now are in the process of defaulting on some of their foreign loans and bonds. So I think that's really putting a bit of a dampener on the copper price. And then in conjunction with that, because of the slowing economies, we're beginning to see inventories in various warehouses around the world, starting to rise to, highs that we haven't seen in the last couple of years. So that's sort of dampening the copper price. And as a junior company, our stock tends to trade in line with the copper price until there's a real transformational change. Now, the MRE is a great foundation, but until we put out the pre-feasibility study and can actually show the market that, with today's inflationary pressures, with the real capital cost items in there, with first mineable reserves and actually showing, robust project economics, and the project is actually financeable, I don't think the market's going to give us a pass. And, within the company, we actually discussed, whether the MRE would have any, appreciable impact on the share price. And we came to the conclusion, no. But what it will do is it will draw even more attention to the company. And that's absolutely what we want to see, because when we put those results out in the first quarter of next year on the pre-feasibility study, we believe that will be the transformational event because of all those issues or items that I just shared with you.
Well, what I heard in some of the interviews that you did after that MRE is also that you're working with a rather aggressive timeline, as I mentioned at the beginning, production by the end of 2026. means what about a 3-year timeline from now on? So that's through PFS into DFS, finance it, staff it with mine builders, build it, staff it with mine operators, and then start production, do that successfully. Like, so it's more than what it sounds like. Oh, let's just build a mine. What kind of IRR and CapEx do you think it will take for you to achieve that timeline? And is that the only thing that it's dependent on, project economics, or is this something else that comes into the mix?
No, it really comes down to, as you said, the project economics and having a project that is actually financeable. So we're in the midst of, completing the pre-feasibility study as we speak. I don't know what those results are going to reveal, but the guidance that we gave to the consultants and the project team, as I said earlier, was to try and have a project that would have a 25-year plus mine life, would average 50,000 tons or thereabouts of copper cathode per year. We wanted to try and build the project for sub 400 million US dollars. And we were looking for an after-tax IRR that was at least at or above 20%. So we felt that if we could hit those targets, then on a standalone basis, the company would have an opportunity for actually financing that size and scale of project. And we could do that within the next 3 years, as you've pointed out.
25 years, 50,000 a year, right?
Yeah. So if you take that mineable resource that we just put out, and we work with the 4.4 billion pounds of copper that is leachable, that's in the measured and indicated category, you never get 100% conversion of resources to reserves. So let's just assume that we get an 80% conversion. That would take the 4.4 billion pounds down to around about 3.6 billion pounds, because we've lost 20% of the resource that doesn't convert over into reserves. When you then actually do the mining, you're moving this material around. You never get 100% recovery from the mining. There's always a 5 to 10% loss in mining. So let's just assume that we lose 10% of the copper. So 3.6 billion pounds goes down to 3.2 billion pounds. So that 3.2 billion pounds then gets put on the leaching pads. And again, you'd never get 100% metallurgical recovery from the leaching pad. There's always losses there. And right now, the oxides are giving us a 90% recovery. The transition-ray secondary sulfide is giving us high 70s to low 80s. So let's just assume that the overall metallurgical recovery is 80% on 3.2 billion pounds of copper. That would then bring you down to 2.6 billion pounds of copper that would ultimately be produced as a cathode. So if we take 50,000 tons of cathode production, which is 100 million pounds of production a year, and we multiply that by 25 years, yet funnily enough, you get 2.5 billion pounds of copper being produced in cathode. So if you work that backwards, you would obviously get to the 4.4 billion. So that's why we're quietly confident that this resource that we put out now with 4.4 billion pounds of measured and indicated leachable material gives us an opportunity to at least attain those objectives that we set for the consultants and the project team from a production profile and life of mine perspective.
But you're not necessarily working with the idea that you're getting this to 10 billion pounds, are you?
No, certainly we are. A lot of the focus this year and next year will be further infill drilling, further de-risking the project from a technical perspective. Obviously, as we said earlier, amending the permits so that at the end of 2024, when we have the bankable feasibility study and assuming the project financing's in place, we're shovel ready to start breaking ground to see first production by the end of 2026. But in conjunction with that, there are areas on the property that are underexplored. Park Salyer south onto the Mainspring property needs to be drilled out. There's a 1 kilometre strike length between Cactus West, the open pit, heading to the southwest to Park Salyer, known as the Gap Zone, that needs to be drilled. And then there's a northeast extension, another kilometre of strike length northeast of Cactus East, which will be an underground mine adjacent to the Cactus West pit that needs to be fully explored. And we believe if we can see the same type of exploration success that we've seen on the project over the last 3 years, where our discovery cost is under 1 cent a pound of copper, if we can see that same success in the next 3 years, this resource will further grow beyond 10 billion pounds of copper. And why the exploration is important is that obviously, as far as news flow is concerned, we're into a relatively mundane period of the project between PFS and actually announcing the bankable feasibility study and project financing. So one way to sort of keep some excitement and blue sky potential around the project is through exploration success. Obviously, we're not going to be throwing all of our dollars into exploration, but in the last 12 months, we've seen $3 to $4 million go into pure exploration, which is approximately 10% of our overall budget. And I suspect, although we haven't completed our 2024 budgets as of yet, I suspect once that goes to the board and is approved in early December, 10 to 15% of our budget next year will probably go into pure exploration and not infill or technical drilling or technical report.
How much are you paying per meter of drilling in Arizona?
Right now, it costs us $65 a foot. So that would be about $200 a meter in metric. Remember, we're in the US, so we deal with imperial, but about $200 US a meter all in.
Okay. Well, I'm European, so it doesn't make it any easier on me. Nothing is really easy to me, but let alone converting these numbers. Okay.
And to euros as well.
That's true. I'm not so because that's something I've been thinking about. Where's this growth specifically going to come from? Because I've heard you allude to it that you could go to that 10 billion pounds, and there aren't many deposit models there aren't any 3D models of your entire land package, even though you work with Verify, if I'm not mistaken. Why are you planning on releasing something in sort of a 3D or easier version to visualize?
Yeah, we have 3D Verify models on our website today, but they all relate to the PEA.
Yeah.
We're in the process right now of having Verify update all of those models. Several weeks ago, we provided them with all of the drill hole database, including this new mineral resource update. And I suspect in the next couple of weeks, we'll have those models updated on our website that people can spin around and take a look at from a 3D perspective. But what's interesting is when you look at the model 3D and even in plan view today, you'll notice that Park Salyer is cut off right on basically the property boundary. And the reason for that was that we only picked up an option on that property in January or February of this year. So there's been no drilling by ourselves conducted on Mainspring. And when you look in plan view at Park Salyer, it almost looks like it's a hot knife going through butter, and the mineralization just abruptly stops in a straight line. That is not factual. And we know that because ASARCO drilled on the Mainspring property 3 and 4 decades ago when they owned this property, and they actually hit mineralization. So we currently have a diamond drill that's moved on to the Mainspring property. And between now and the end of the year, we intend to put in up to 10 exploration holes so that we can announce that to the market. Now, at best, we'd be looking at an inferred resource, and it may not even qualify as an inferred resource. But the bottom line is it cannot go into the pre-feasibility study as far as the mine plan and the financial and economic model is concerned. But we will be able to talk about Mainspring in the opportunity section when we start thinking about, further blue sky opportunities for growth on the project. And I think that represents a really big one.
George, this sounds like a straightforward story, and it's been straightforward for you. You've been drilling, growing the resource, coming out with a PEA, and you've been following everything nicely, financing it. Everything's been going relatively as well as it can go for an exploration company. There's always challenges, of course. Yep. How come nobody did that before you? Like, why are you the lucky one or the chosen one to make this work?
Well, you've got to go back and delve into the history of the asset. So it was owned by ASARCO in the late 1960s. It went into commercial production in 74, and the mine closed in 1984 when it was uneconomical, although there was a lot of mineralization still in the ground. And because it was a big open pit, the average, the annual sort of cost to keep that open pit on care and maintenance were not that great. So ASARCO basically mothballed the operation on the hope that the copper price would improve. Now, remember, in 1984, when the mine closed, copper price would have been $60 cents a pound. So they kept it on care and maintenance for 20 years. And then in 2004, ASARCO themselves actually filed for Chapter 11 bankruptcy protection in the US. And Grupo Mexico stepped in and acquired a lot of their assets, but they didn't acquire this one because even back then, copper was still below $1 a pound, and the mine would be uneconomical at those copper prices. So the asset falls into a state trust that is actually managed by the Arizona State Lands Department and the Arizona Department of Environment and Quality. Now, those two groups are very important because they are two of the main regulators who have provided us with our permits for the Cactus project today and will be responsible for the amendment to the permits to include Park Salyer. So this asset, ASARCO funded the state trust with $20 million. And over a period of 15 years, the state trust basically spent that money and additional taxpayers' money cleaning up 95% of the site. So the old copper concentrator is gone. The old tailings facility has been fully remediated. There's no environmental issues there. All of the old buildings and chattels were all taken down. The only thing that remained essentially to be cleaned up was a surface stockpile, which essentially was the waste pile. Now, it was waste because back in the 1970s, copper concentrators do not have the ability to process oxide material. So all of the oxide cap on this copper porphyry system, plus any sulfide material, which was at 0.3% copper or below, which was their copper cutoff, went into the surface stockpile. And today, there's over 80 million tons of mineralized material at 0.15% total soluble copper, yielding 224 million pounds of copper sitting on a surface stockpile that was actually going to cost the Arizona taxpayer money to pick that up and probably bulldoze it into the open pit. So fortunately, my predecessor was able to go to the various state lands department and ADEQ and other people within the state legislature and convince them that rather than spending taxpayers' money on bulldozing that material into the open pit, with today's technology, which has advanced in the last 40 years with heap leach and a solvent extraction electrowinning plant, we could actually recover copper from that surface stockpile. It would create jobs. There'd be a lot of disposable income going into the local economy. All the material would be picked up and put on a special engineered design pad today that would capture any solution that came off of the pad. which wasn't in place, obviously, in the 1970s and 80s. And of course, over time, we'd be paying state taxes and federal taxes. So it seemed like a really great win-win solution to the problem. And in late 2019, we were able to acquire the asset out of the state trust by paying the state $6 million US. So we started with 224 million pounds in stockpile. And then as we've slowly drilled around the property, including in the old open pit, next door to it at Cactus East and then Park Salyer, we've suddenly now grown the resource in the last 3 years to 7.4 billion pounds of copper in all categories. So that's why we got the chance to, move this project forward, and why nobody else has tried it in the past, because it was essentially forgotten and it sat in a state trust for 15 years.
But there's no legacy challenges or something else that you were left with that you're still to solve?
The only thing we have to solve for is the surface stockpile. And of course, with 2.5 years of metallurgical testing, we're seeing that through the simple application of sulfuric acid and using a drum agglomeration, we see that we can recover 90% of the copper from the oxide material, which is principally what the surface stockpile is today.
So metallurgy is something else that kind of got me confused here, because I don't understand it completely. It's not your fault. It's mostly my limited brain capacity, but you don't have a straightforward deposit-wide metallurgy. Like, it's not one thing. There's different types. So there's a lot of stuff happening there, right? How do you deal with that, and how does it affect deposit-wide recoveries?
Well, there's two types of ore that we will go after, which we can leach. There's the pure oxides, which is simple sulfuric acid, and then there's a secondary sulfide, which in this case is chalcocite. And that has been leached by other operators, including Freeport-McMoRan in Arizona. And that's a simple bio-leach process. So the oxide and the secondary sulfide go on to two separate independent heap leaching pads. And that's all standard proven metallurgical technology that will leach out that copper. In the global resource, however, and that is part of that 7.4 billion pounds of copper, there's approximately 2 billion pounds of that, which is a primary sulfide, in this case, chalcopyrite. And the standard normal way to recover the copper from the chalcopyrite is that you would put in a copper flotation mill and make a concentrate, which then would have to be shipped off to a smelter and then further refined into copper cathode. We, as all of the plans that I've shared with you today, we have no intention of going today and mining the primary sulfide and putting back in a flotation mill. The reason for that is that the capital intensity is much, much higher than a heap leach SXEW plant. It's easily 2 to 3 times the amount. And as a company, we just wouldn't be able to raise those finances. And from a pure NPV and an IRR perspective, it's not as accretive as the heap leach operations, using long-term copper prices of probably $3.75, $3.80 is probably what our assumption is going to be in our PFS. Where there's optionality and where there's opportunity for the primary sulfide is part of the reason why Rio Tinto put a 7% investment into the company. As part of their copper division, they have a sub-group known as Newton, who have been experimenting for the last 20 to 30 years internally within the Rio Tinto group of companies with a leaching technology called Newton, which essentially is a bio-leach that will leach out the copper from the chalcopyrite. And the beauty of the technology, if we can prove it successful, is it can take advantage of a standard leaching pad and a standard SXEW plant with very little incremental capital required. So the capital intensity becomes very low. It means that you can recover copper using a leaching technology. You don't have to send it off to a smelter. which, in turn creates more greenhouse gases. So it kind of defeats the purpose of trying to produce this copper and use it for the green energy sector when you're throwing up all these greenhouse gas emissions into the atmosphere. So, at the end of the day, we see it as an opportunity, but we're not factoring it into any of our current business plans, as the technology still has to be further tested over the next 6 to 18 months. And the primary sulfide as well, that predominantly sits at the bottom of that open pit, is currently only drilled out into the inferred category. So again, if it ever was going to go into a PFS and then a definitive bankable feasibility study, there's a lot more infill drilling that would be required for the primary sulfide.
So the $400 million CAPEX that you mentioned, that's starting with an open pit and the stockpile, and then further on, when the mine starts cash flowing, and going to use that to then potentially build the underground operation.
Yeah, exactly. So we go after the easy material, so to speak. Obviously, that's a surface stockpile. It's a pit layback. When it comes to the pure mining from an execution perspective, that's much easier to do than actually going underground. But as you correctly alluded to, once you do the pit layback, once you've mined out the east side of the pit, there's an ability to drive a decline into Cactus East. That helps us with timing and obviously less capital development, given the bottom of the open pit currently today is already 1,000 feet below the surface. So we can access the top of Cactus East relatively quickly, and that can come online sometime in year 5 and 6, I believe, in the current PFS. And then slightly behind that, once we've paid off our debt, once we're free cash flowing, from operations, we can turn our attention to Park Salyer, which is again another underground mine, but it's much bigger than Cactus East. Cactus East in this resource, if you read through the notes, is sitting at 41 million tons of over 1% copper based on a total soluble copper percentage. When you turn your attention to Park Salyer, we're currently looking at 130 million tons, again at over 1% T-sol. So it's 4 times larger than Cactus East, and that allows you the ability to scale it up.
But 1% copper. If you go to 1% copper, what's that? About $80, $80 a ton.
$80 a ton. $80 a ton rock. Now, when it comes to the mining underground, obviously the costs are higher than an open pit. But given the geometry of both these deposits, we'll be looking to mine them using what's known as a sub-level caving operation. It's not a block caving, but it allows us to mine it sort of in increments, similar to a block cave. But it reduces the timelines and it reduces the upfront capital utilizing sub-level cave. And if you go through our sort of economics of how we determine the cutoff grade, you'll see that for the sub-level cave, I think we're in at around $27 a short ton for the mining using sub-level cave. And if you look at other sub-level cave operations around the world, you'll see that their costs can be as low as $20 up to $30 a ton. So we haven't just plucked that number out of thin air, but we've built it up, built it up from zero. But at the same time, we've also looked at other operations around the world that would be very similar as far as size and scale is concerned to this operation.
Well, what about, so that's operating costs. What about processing costs?
Well, processing costs, again, for heap leach operations are, quite low compared to a concentrator and a flotation mill. So I think we've got those numbers in and around, I think it's $2.50, $2.70 a ton. And then on top of that, obviously, you've got G&A, which again is below $1 a ton.
How is G&A below $1 a ton? That's not usual.
Why? What do you mean?
Well, I would have assumed it's more than that. I would have assumed it's like $2 or $3 a ton.
No, the number that I think we've got in our for a cutoff is around 50 or 60 cents a ton. It's very much dependent upon the scale of the operation and the number of tons you're actually mining. So remember, with a surface stockpile and 80 million tons being there, our intention is to mine 12 million tons of stockpile material a year. Mm-hmm. So within 5 years, essentially, your stockpile is mined out. And then, of course, you've got a big open pit as well. Not initially, but once we did the pre-stripping and we get down into the guts of the open pit, that will also be mined at 12 million tons annually. So, those combined would give you 24 million tons of material that you're mining on an annual basis. That ultimately drives down your unit cost on a per ton basis.
Right. Okay. Well, that's making sense. And it's a 1% heap leachable. That also sounded like that caught my attention at first. That's something that like you're absolutely certain you can do that. There's no risk to it, or like how do you look at it?
No, with 2.5 years of metallurgical testing, we feel very confident that the numbers that we're putting into the pre-feasibility study are absolutely, rock solid. And the other thing that we do as well is, with a 90% metallurgical recovery on oxides, high 70% on the enriched material, their overall weighted average recovery is going to be probably between 80 and 85%. Based on the distribution of material that we have. If you go, and it's on our website, and look at the top 10 producers in the US today, and most of them are in Arizona and they use a leaching technology. If you actually look at the recoveries, they're around 80% is what the top 10 appear to be averaging. So I think the numbers that we're actually going to be using in our PFS and that are supported by over 2 years of metallurgical testing are very much in line with what we see in Arizona with producers today. So it's not as if we're way out in left field with something that nobody else is actually doing.
So it's if we assume $80 per ton of material, you're doing 80% recoveries on that. That's $64 of value that you're getting out per ton, and it's costing you $27 in operating, $4 in processing, and allow for some margin here and there of, let's say, 10% margin for mistakes, round it up to 35. So it's 64 value that you're getting out, and it's costing you 35 all in to get the material out of the ground. Does that make any sense?
You're on the right track. Obviously there's marketing costs and transportation and other things, but yeah, I don't think you're going to be too far off if we're looking at $40 a ton, sort of all-in costs, and we're at the end of the day, as you rightly pointed out, with 80% recovery, we're looking at something at $60 to $65 a ton is actually what we're bringing in.
Okay. And how many tons is that you're going to be?
Well, as I said, on an annual basis, when we're up at full steam and we've got the underground, the open pit going, and we've got the Cactus West going, it's 24 million tons a year. Within the first 5 years, we're up at that type of production profile.
Okay, 24 million tons. If you make $20 profits, and that's so at what stage? Because that's obviously not, when we say 2026, that's not something you have going on in 2026. That's out in the future, fortunately.
Yeah, but yeah. We can ramp up quickly, though, and the reason for that is the surface stockpile is already sitting there, and the open pit has already been substantially developed because it was previously mined. So I think it's in year 3, year 4, we're running at that type of production profile, certainly for the next 3 to 4 years, and then obviously the stockpile's depleted, and then we're starting to get into the underground mining, and of course that's where the grades improve, but the tons go down at that juncture in time, right? But as far as the underground is concerned, the grades compared to the surface stockpile are 5 times greater, because now you're mining 1% material versus 0.15% material. But you're no longer mining at $2.50 or $3 a ton. you're mining at $25 to $30 a ton.
Right, right. There's also, I assume, pre-stripping that comes into that as well.
Yep, exactly. Yep.
What are you making of pre-stripping? Is that something like, is that going to be a substantive cost, or how do you look at it?
No, it's not really a substantial cost in the sense that the open pit is already there. So, depending on which wall we decide to go into first, because we don't pre-strip the entirety of the pit circumference, we've got to determine, do we want to go in on the north side? Do we want to go in on the southwest side? Are we going in on the northeast side? I think based on the mineralization I'm seeing at the moment, it looks as if the west and the southwest of the open pit is probably the area where we go in first. And of course, that can change the stripping ratio because the distance down to the mineralization is different depending on which area that you go in with.
What would it change it to?
Well, the stripping ratio overall is still pretty low. I mean, I think it's sub 2 to 1. So as far as open pits are concerned, ultimately you'd love 1 to 1 or less. But, if you can see a stripping ratio below 3 to 1, that's usually a very good sign. And this one is sub 2 to 1.
Okay. But then when you move on to the, what did you say, southwest wall?
Yeah, the southwest corner is probably the area where we've got the most mineralization and the best opportunity to, get into the ore as quickly as possible for less stripping as possible. So, I mean, ultimately with these projects, what you want to try and do is minimize the capital as much as possible and, get into, as much profitable ore as quickly as possible to maximize the NPV and the IRR of the project and generate real cash flow, right?
So if I say the word ore crusher, that's not something you want to hear.
Well, there will be crushing required on this project. That was one of the things that was missing from the PEA, and of course it's a PEA, so it's plus or minus 50%. But the PEA was looking at run of mine ore, both from the underground and the open pit. It was going into various trucks. Those trucks were being driven right up onto the top of the leaching pad, and then the ore deposited and then spread out with a grader. And, these trucks from the open pit can be 100 ton. I think we're even sizing 150 ton as an option. Some mines, big enough mines, use 300 ton payload capacity trucks. And when you drive those type of trucks up on top of the leaching pad, it causes a lot of compaction, and that can affect permeability and porosity, and therefore you don't get good leaching and good recoveries. So effectively you've got to come back and rip the top of the pad, pretty much like a farmer ploughing a field and getting ready to plant potatoes. But rather than ploughing the field, let's say 6 inches, you've actually got to go down maybe 10, 12, 15 feet, and it causes a lot of operational issues. So our plan with the PFS, now that we did the detailed metallurgical testing in the last 2+ years, is that we look at size fractioning of the ore and where we get optimum recoveries. And with the test work that we've done, we've seen that 1 inch minus passing 80%, or even 3/4 inch minus passing 80%, is the optimum size fraction of the ore we require to get that high 70 to 90% recoveries. When you drill and blast ore in an open pit or underground, you're never going to get the material down to 1 inch minus passing 80%. So you've got to go through a 2-stage crushing plant. So there'll be a primary and secondary crusher certainly required for the underground and surface material. And then the other thing we realized is that we want to put the sulfuric acid and the various chemicals onto the material before it actually gets on the pad. So we look at drum agglomeration as well. And then we want to avoid putting the trucks on these pads. So that means we use a conveyor system, and then we put in stackers to actually deposit the material on the pad. So we keep all the big, heavy equipment off of the pad, and we don't suffer those compaction problems and all the operating challenges of trying to sort of fluff up the top 10 feet of the pad.
Hmm.
So all of that will add additional capital over and above what we had in the PEA. And then, of course, we're in a higher inflationary period from where we were in the summer of 2021. But as I said earlier, the guideline to the consultant says, can we still get this built for sub $400 million at that 50,000 tons and 25-year mine life? So the CAPEX is increasing over and above what was in the PEA. But remember, the production profile is almost doubling, and we're hoping to add in at least another 7 to 10 years of production over and above what was in the PEA as well.
Right. Well, so because I also wanted to talk about a processing facility, but I think that about addresses it as well, because I assume you're going to approach a processing facility in the same way that you're going to approach the mine, where you're not immediately going to, I mean, you're going to expand the processing facility over time. You're not going to come out, or are you going to build it all at once?
No, we won't build it all at once. I think if you're talking about the SXEW plant, I think we're initially building a plant that would have a 30 to 35,000 cathode ton per annum capacity. That sort of takes care of the first 4 years as we ramp up production. And then it'll be expandable in year 4 and 5 to then take us up to that 50 to 60,000 ton capacity that we'd obviously, want to see at some juncture during the mine's life. And even above and beyond that, everything that we build and construct here will be expandable. So we'll be able to bolt on and further grow it if required. I mean, it's going to take another, as I said earlier, probably 12 to 18 months of testing for the Newton technology. But ultimately, if that technology were to prove successful and we want to scale it up, we have to ensure that the design work we're doing now gives us the flexibility for actually treating the primary sulfide on the leaching pad. And of course, having access to potentially another up to 2 billion pounds of copper from primary sulfide would allow us to then further increase the production of well beyond that 50,000 tons that we're currently envisaging now.
So why I'm asking these questions is because I'm trying to better understand what goes in that assumption of your CAPEX, because the way they have it right now, again, $400 million assumption for CAPEX, that's not too bad for a starter operation when we compare it to an NPV of again, in the realm of speculation. If I say a $1 billion NPV, does that sound outrageous to you or not?
Well, I can't comment on the NPV, but certainly, the CAPEX of around 400 million isn't that outrageous. I mean, if you think about a 40 to 50,000 ton cathode producer, that would be 8 to 10,000 tons dollars per ton as far as capital intensity is concerned. There are heap leach operations that have been built around the world for that type of capital intensity. As we sort of alluded to earlier, if you were looking at a flotation mill, suddenly now you'd be looking at something that would be $20,000 to $30,000 a ton, and therefore the capex numbers we'd be looking at would be 800 million to 1.2 billion. Being a company that only has 130 million US dollar market cap, there's no way we could finance that without either selling the asset or bringing in a JV partner, of some sort. So what we are trying to do with our business plan is be in control of our own destiny. It's not to say we don't bring in a partner or JV with somebody at some future juncture, but we want to be at the negotiating table with that party, having the ability to walk away if we don't get, a fair and equitable deal for the shareholders of the company. And being in your control of your own destiny gives you that ability, that leverage at the negotiating table.
$400 million, still not child's play to finance, though. So what's sort of the plan there?
Well, and believe it or not, in mining terms, that's actually quite a small sum of money for a copper mine to be in production in the next 3 years in a very, very safe tier 1 jurisdiction. But yes, I mean, it's not a trivial amount of money. Ultimately, I don't know what the debt to equity split is going to be, but let's just assume for now, for argument's sake, that we're looking at 50% debt, 50% equity. So if we were looking to raise 200 million US dollars in debt, if we had a 5 to 6 year tenure on that debt, meaning that's the time period where we have to pay the debt back, if we can see a mine life that's 25 years plus, that would give us a tail on that debt of approximately 20 years. So there's various debt covenants and debt ratios that the project financiers will look at. And one of the big ones for them is, is there a long tail on the asset? Because at the end of the day, if something goes wrong and you're not able to pay the debt back within that 5-year time period, if you have more time, beyond that, there's a more opportunity or ability to refinance, to renegotiate, and ultimately, they get paid back their initial investment and all the bells and whistles that ultimately will go with that. So we strongly believe, and that's the reason why we've been targeting, trying to see if we can build this thing for sub $400 million, that if we could attain that, we strongly believe that a project of this magnitude, given its location, given the fundamentals on a supply and demand, basis in the US, that this project would be financeable if we could attain those goals that I've laid out as part of the pre-feasibility study.
Is it too early to talk about the who of the whole story? Like who's going to be financing it? Because I'm assuming Tembo Capital. I mean, they're still in there. They seem to have been a supporting shareholder over the last 3 years or so. So are you assuming they're going to come in for a portion too?
No, we're not. That's not part of Tembo's business model. Tembo likes to get in very early with private companies, take them public, continue to invest in the company with their rounds of funding, to fund the programs, but they're not project financiers. So no, I would expect that they're going to continue to support the company between now and the BFS, but they will continue to allow themselves to be diluted down. Remember, pre-IPO, they were a 45% shareholder. They participated in the IPO, I think to the tune of $12 million, but post-IPO, they were a 38% shareholder. We've conducted in the last 2 years two $30 million fundraisings. Tembo's participated in both of those. But again, today they're now down to 31%. And they recognize that, liquidity is important in the junior sector. 31% shareholding is perhaps a little too large. So there's opportunities on further financings, as I said, between now and project financing, where they will participate, but ultimately they probably like to see themselves go below 20%, which then helps with liquidity. Can't say specifically who we've been speaking to, but I can tell you that we have obviously been speaking to the commercial banks that lend in our space. And of course, there aren't many of those. It's a shrinking pool of capital. But we've also been speaking to some of the other typical debt funders that you and your listeners will definitely know. And a lot of them have a very strong interest to sign NDAs and come into our data room. We haven't signed those NDAs just yet and allowed them in. And the reason for that is that we're a very small team. When, these groups start doing their due diligence, it takes a lot of time and resources away from the main project. And at the moment, given that we're still in the midst of completing the pre-feasibility study, we really don't want to drop the ball there. But once the pre-feasibility study is completed, I do expect that we will sign a few NDAs with these potential project financiers, including on the debt, and then bring them into the data room and then let them work with us over the following 12 months as we advance the project through the bankable feasibility study, so they can get comfortable with the project, come to site, see the asset, get to know the management, see all the, run all the sensitivity analysis that they will undoubtedly want to run. And then when we get to bankable feasibility study and announcing that to the market, our goal would be to announce a fully funded project at that juncture in time. and assuming that the economics remain robust within the BFS and we have those amended permits in hand, that's why we're saying we would be shovel ready in late 2024, early 2025 to then move into, pure construction and development.
And the main reason why I'm asking the who question here is because I'm trying to figure out when I'm making calculations later on whether it's going to be fair to use the MPV 5 or the MPV 8 because of the environment that we're in right now.
Yeah, no, for this project, I mean, we're using NPV 8. It's not a gold project, and obviously interest rates have been rising. So, the hurdle rate is going to go up. So, internally within our own models, we use a discount factor of 8%. And as I said as well, we put the resource out using a $3.75 copper price. We're going to probably we're running our financial models right now on that same $3.75. The long-term consensus copper price with about 40 banks that, cover the copper space, various analysts, right now is showing $3.80 a pound of copper long-term. So we're definitely in the right ballpark, and I don't think we would want to step outside of that.
You also mentioned that Timbo will continue to support the company in the meanwhile. That was interesting to see because we had $18 million in August, mid-August of this year. So I'm assuming the vast majority of that money, the majority of that money is hopefully there. But how much more money do you need to go through the PFS and DFS process?
Well, currently, this juncture in time, we're sitting with $15 million in the bank. But the number you stated was as of mid-August, and obviously that was 2.5 months ago. So we've got $15 million cash in the bank. We're fully funded post the delivery of the pre-feasibility study. I don't ultimately know what our expenditures will be for next year. Our fiscal year is calendar year, January 1st to December 31st. We're in the process of working through our 2024 budgets as we speak. And typically those go to the board in early December, whereupon they're signed off. The last 2 years, when we've gone through this budgeting process as myself as the CEO, typically in US dollar terms, we've spent $25 to $30 million on an annual basis. And that includes the various technical reports, infill drilling, and as I said earlier, a little bit of exploration drilling. So I suspect our budget for next year is probably going to show something very similar as far as expenditures are concerned, which will mean that sometime before the summer of next year, we'll come back to market and look to raise money on the back of the pre-feasibility study.
Do you expect the team and insiders to participate in that? Because when I look at insider ownership, it's not terribly high at the moment. So are there any plans for increasing it?
It depends on the individuals, but obviously we encourage people to participate in the financings if their own financial situation allows. I mean, myself personally as a CEO, I mean, obviously I've got some significant skin in the game, if that helps. I mean, since joining the company in July of 2021, I've invested 2.8 million Canadian dollars of my own money at a weighted average price of $2.48. And the bulk of that was done at $2.45, a couple of $1 million, which was actually the IPO price in November of 2021. So I think your listeners should take some solace and comfort in the fact that, the CEO has some significant skin in the game at 35-40% share price higher than today's levels.
How significant is that investment for you? Like, is this the majority of your portfolio, or is it because like
no,
huge amount of money to me?
No. I mean, look. I mean, you at the very start of the conversation, you did advise investors that the junior mining sector is one fraught with risk, and I look at my own portfolio the same way. So I never invest more than 5% of my own net worth in any one company, and no more than 20% of my net worth in any one sector. So again. I'm at the end of the day, if everything was lost on this venture. It's not going to force Mr. and Mrs. Ogilvie into into a retirement home or whatever.
That's what I was trying to figure out, because I was just trying to figure out, if something happens to this, do you have to sleep on the couch, or do you have to sleep on the front porch? So, no,
No,
good
no,
answer.
no. Yeah, no. It's important that shareholders or potential shareholders look at it the same way. You should only invest what you can afford to lose, and should never bet the farm on any company as far as an investment is concerned.
I appreciate it, George. I've been through most of the stuff that I wanted to ask. We've gone back and forth. There's probably a couple of things that I'm missing, but I'm sure we can catch up later on. We have more news again and maybe revisit some of those things. Is there something, though, that you came here hoping to talk about, but I'm failing to bring up?
Well, we kind of touched on it, but look, at the end of the day, the company today only has a market cap of 130 million US dollars, 170 million Canadian dollars. If the listeners do their homework and look at some of our peers, you'll see that they're trading at much higher multiples, much higher valuations. But when you stack the companies up with jurisdiction, phase of engineering, size of resource, capital intensity, C1 cash costs, potential NPV IRR, I think our company stacks up very, very well against our peers. And yet, in some instances, we're trading at a tenth of the value, or at least half of the value. So what it's telling me is that we're being valued right now on the preliminary economic assessment that's 2.5 years old, and that there could be a real transformational event with the pre-feasibility study coming out in the first quarter of next year, if we can deliver a document that is in line with what management has been guiding the market on over the last 6 months as we've embarked on the study. And if that were to happen, then you could see a doubling of the share price here in the next 6 to 12 months once that information feeds through into the market.
Well, I'll be following along. It's an interesting story, and I hope we can catch up as this is happening. So thank you so much for investing your time with me, and I'm looking forward to next discussions.
Great. Thank you, Antonio. Appreciate the opportunity.